years ago when I was a young analyst at Metlife. It was very long ago. It was during the first recession in New York, and found myself foreclosing on many of the New York City prominent landlords, unfortunately. But one of the sort of fledgling groups at that time was a firm called Silverstein and Mendick. And Bernie Mendick ended up to be my partner, and Larry ended up to be my mentor. And Larry Silverstein, more than any single human being, is responsible, I think, for the growth of the Real Estate Institute. He's not here today, but we owe him a great debt. And then over the years, people like Norman Weinberg and Ken Patton have contributed to running the center. Larry and I combined to start the master's program some years ago, and it's turned out to be a very prestigious, hands-on master's program, and many of our graduates have gone on to work for some of you out in the audience today. Just take the opportunity to thank Robin and Adam for putting this together, Jessica Watson. I also want to announce today that we have officially named our interim dean, Rosemary Scanlon, the actual dean of the school, divisional dean, and we're thrilled to death to have her. And I'm not going to take any more of your time. And Adam, I think you want to take it over. So thank you very much.
Jimmy, thank you so much. I think that really put a great frame around where we are here at the NYU Schack Institute. As Jimmy said, I'm Adam Emmerich from Wachtell Lipton. On behalf of the REIT Institute, the REIT Center, and my partner and co-chair, Robin Panofka, I'd like to welcome everyone today. We're well into the second decade of getting together under NYU's auspices to talk about REIT M&A, so going back almost to the beginning of the modern REIT era. And so I like to think that we have both the benefit of experience and the enthusiasm of youth still on our side. We have a record crowd today, so I think both REITs and REIT M&A are still going strong. We had a strong comeback, as you all are aware, in 2011, and I think REIT M&A in 2012 is not far behind. First, let me just say, as Jimmy said, this conference did not happen by itself. I'd like to start with a couple of thank yous to Jessica Strata-Watson, to Karen Gabbard, and to all the people at the Schack Institute who've made this day possible and made our job so easy. I'd also like to thank again Rosemary Scanlon, who, as Jimmy said, is now the new official dean of the Institute, and she has done excellent work, and we're looking forward to a wonderful continuation of her tenure as dean and her presiding over another fabulous NYU REIT symposium. And thanks to Jimmy, who is, as he just said, goes back to the very, very early days, the beginning of what's become a jewel in the crown of NYU and the New York real estate community. We're in for a very interesting day today. We're blessed again this year with an extraordinary group of panelists and a fascinating array of topics. We've been on a roller coaster of change in the REIT world, as you know, for the last 4 years, sometimes terrifying, always fascinating. A very active year of REIT M&A behind us, and I think reason for optimism from the last 18 months. Just mention a few sort of statistics and facts and things to set the stage for today, and you'll hear more about all of them as the day goes on. At a macro level, commercial property prices have continued to increase. The Green Street Commercial Property Price Index is at 93% of its August 2007 high, and this has been reflected and then some in the REIT world. Apartment and mall REITs have seen the highest percentage increase over the past 12 months. Retail REITs have seen increasing sales and declining cap rates over the past 2 years. Equity returns for retail, residential, and healthcare all outperformed the NAREIT index in 2011. And as our next speaker will attest, the storage sector has been particularly strong. Total equity returns in 2011 exceeded all other REIT sectors. REIT M&A has continued to pace with a comeback over the past 2 years. A strong 2011, headlined by Prologis and Ventas with a hat trick for the year. We'll hear more about that from Debbie Cafaro later today. For what we're seeing, 2012 looks like another interesting year, headlined by Simon's landmark Klépierre deal in Europe, and perhaps a signpost on the beginning of a wave of global consolidation by the largest and most successful REITs. As Steve Roth recently observed, the cost of money is critical to success in real estate. Debt and reasonable moderation is available, and stock sales are a strong currency for strategic deals. The equity markets are strong. So let me just mention a couple of factors that we think will be hallmarks for REIT M&A in 2012. Strong balance sheets and cash positions, scarcity of new development opportunities, availability of credit and strategic debt positions, and continuing globalization. A couple of other statistics to give you a picture of the REIT industry, which is quite interesting, I think. At the end of 2006, there were 183 REITs with a total market cap of $438 billion. By the end of 2008, that number, both of those numbers had been decimated, with 136 REITs left standing, with a total market cap reduced by more than half to $192 billion. As of the end of Q1 2012, the number of REITs has increased modestly to 152, and the market cap has roared back to $528 billion. So although the Morgan Stanley REIT Index is still roughly 30% off its February 2007 high, what we've seen is a massive return of the REIT sector, and perhaps the beginning with a reduction in the number of REITs of Sam Zell's long-standing prediction that there'll be a nationwide and perhaps a worldwide consolidation in the REIT world. Debt is perhaps higher than Mike Kirby would like, at 55% overall to the public equity of the REIT sector. 45 REITs, which represent 63%. So again, you can see the consolidation at the top end in many ways. 63% market cap of the REIT world is investment grade. 16 REITs are in the S&P 500, and Simon is in the S&P 100. So the preamble and the lesson of the last little while is that the 2008 crash is not forgotten, but the real estate market in the REIT world seems to have turned the decisive corner from the worst of the recession, and opportunities abound for those who can pay in cash and have strong equity currencies. Many of the people who are on the front lines making this news and making up the REIT sector that I've just talked about are here today, so we're in for a treat. Now, if Dean Scanlon will join me, she'll have the distinct honor and privilege of presenting a special award this morning to Ron Havner, who she'll introduce. Thanks, Rosemary. Thanks, Ron. Please come up as well. And thanks especially to each of you for being here today.
Good morning, everyone. My name is Rosemary Scanlon, and I'm so pleased to welcome you all here to welcome the speakers for this, what looks to be a terrific day, to welcome our graduate students. You will see our students throughout the hall and at coffee and lunchtime. We're so thrilled they're here. And it's my pleasure this morning to introduce to you Ron Havner, who's the chairman and CEO of Public Storage, which is one of the biggest and most highly respected REITs in the United States, and easily one of the largest real estate companies and landlords, as we will find out, in the world. Ron has been instrumental in building Public Storage over the years, and he's highly regarded for his stewardship of the company. And with a balance sheet that is described as a fortress balance sheet, he sailed through the financial crisis with flying colors. So we hope to hear about that, Ron, in your remarks today. Just a little bit about his period of ascendancy in the company. He joined Public Storage in 1986, and he held a variety of senior management positions over the years, and then was appointed CEO in 2002. And just some statistics on the size of Public Storage. It's grown into a $23 billion giant. It's the largest self-storage company in the world. It has over 1 million customers. It has 2,200 self-storage locations, right, in the United States and in Europe. And that totals over 141 million net rentable square feet. And his business parks subsidiary adds another 27 million rentable square feet of commercial and industrial space. So this is a very large company that's rated A by Standard & Poor's and is a part of the S&P 500 and the Forbes Global 2000. Ron is also a member of the Board of Governors and the Executive Committee of REIT. We're proud to say he's a member of the New York University REIT Center Board of Advisors. It's my pleasure to introduce him and also to give him an award from NYU Schack. And the award says, it's the 17th Annual REIT Symposium. Today is titled Doing Deals in Volatile Markets. Ron Havner, Chairman and CEO of Public Storage from NYU SCPS. Thank you, Ron.
Thank you very much. Yep. So, thank you, Adam. Thank you, Robin. Thank you, Dean Scanlon. It's an honor to be here this morning and address this esteemed group. I've been attending this conference since 2005 when Adam and Robin started teaching me about mergers and acquisitions. I'm forever grateful to them and this conference because they were invaluable in helping Public Storage consummate the merger with Shurgard in 2006. It was a transformational transaction for Public Storage and the self-storage industry and defied conventional wisdom. I see a number of friends and business associates in the audience today, and for those that have known me and the Public Storage organization for a long time, they're probably wondering what I am doing up here. At Public Storage, we tend to follow the advice of Abraham Lincoln. It is better to remain silent and be thought of as a fool than to open one's mouth and remove all doubt. So at the risk of being foolish, let me spend a couple of minutes talking about one of my favorite subjects, public storage. When we started the business in 1972, our equity capitalization was only $50,000. In 1995, Public Storage went public through a reverse merger, and today our equity capitalization is about $23 billion. Over the last 16 years, our shareholders have enjoyed a phenomenal return. Total return has been about 1,200%, or 18% a year compounded for 16 years. Our share price has risen from $14 to about $140, and our dividend has increased from about 80 cents a share to $4.40 a share. It's been an incredible ride. Now, I could tell you that we are brilliant, visionary, incredible operators, and buy only the best assets. I could probably support these with charts and statements and analysis, but that would be a little misleading. Instead, we're more like a golfer that is able to recover from a bad shot and still post a good score. We've hit the ball out of bounds many times, but just like Jack Nicklaus, Phil Mickelson, or Bubba Watson, we've been able to recover. Let me give you some examples of our out-of-bounds shots and recoveries over the years. Our first out-of-bounds shot was naming the company Private Storage Spaces, which is what we sell. We thought our name conveyed our product. However, people got confused, thinking we didn't rent to the public, only to selected private customers. Being ever nimble, soon after the first couple of facilities were open, we renamed the company Public Storage. Who knew 40 years later our name would define our industry and be synonymous with our product? Our second out-of-bounds shot was leveraging and selling our properties. In the beginning, we'd get a construction loan, build a property, then mortgage, and sell it. We made a nice profit, which helped us do the next deal. That worked fine as long as there was financing. However, by 1975, the prime rate was 12%, and by 1981, it peaked at 21%. Those are interest rates hard to imagine in today's interest rate environment. This forced us to raise money with all-cash limited partnerships. Now, in the 70s and 80s, real estate deals were usually highly leveraged, so an all-cash deal was very unusual. Our first partnership took 9 months to raise $2.7 million. Our next partnership took 3 months to raise $5 million, and our third partnership was raised money in about 3 hours. The all-cash limited partnership became our model throughout the 80s. Over the next 12 years, we raised about $2 billion in 100-plus partnerships. Our capital raising skills helped us grow into the industry leader, a position we've held since the 70s. The all-cash structure also helped us through the high interest rates and saved us from the fate of most real estate syndicators that went bust during the savings and loan crisis. In 1980, we IPO'd a company called Storage Equities. We sold 2 million shares, raising $30 million, which in 1980 was big money. It was the first REIT IPO since the 60s, and the company eventually became what is today now known as Public Storage. However, we first had to hit the ball way out of bounds. Despite starting out as an all-equity company, we couldn't resist the temptation of leverage. Like most real estate people, we fell into the trap Warren Buffett so aptly described in his annual report. Leverage is addictive. Once having profited from its wonders, very few people retreat to more conservative practices. Borrowers then learn that credit is like oxygen. When either is abundant, its presence goes unnoticed. When either is missing, that's all that gets noticed. Even the short absence of credit can bring a company to its knees. Over the next decade, we leveraged storage equities to buy properties directly. We leveraged storage equities with joint venture partnerships to buy properties. And we borrowed to pay dividends equal to FFO. By 1990, our debt was greater than our equity. We had reduced our common dividend twice, and we had fully drawn down our line of credit. We were leveraged with few alternatives. We realized then that REITs have a limited ability to retain capital. That probably sounds familiar to some of you who just escaped a near-death experience in 2008 and 2009. Having brought storage equities to its knees, we endeavored to find a form of leverage that did not need to be repaid. Leverage with no repayment requirement. We traveled to Wall Street in search of a new security. We were rebuffed by every major firm. Recall, we rent garage space and don't own institutional-grade real estate. We finally made a connection with the firm Solomon Brothers. They were losing clients en masse. Remember the Treasury scandal of 1991 when Warren Buffett took charge of the firm? So they were very happy to help us. In 1992, we issued the first public preferred stock by a REIT. It took us 6 weeks to raise $45 million with a 10% coupon. We were happy to get the money. A month ago, we raised $460 million in 2 hours at 5.75%. Referring back to my golf analogy, our recovery shot was very good. There have been many other out-of-bounds shots along the way. Our diversification into boat marinas, pizza restaurants, flower shops, brokerage, and portable storage all proved to be very expensive lessons. Through each of these mistakes, though, we gained a greater appreciation for what a wonderful business we stumbled into in 1972, self-storage. Our business, combined with the absence of debt, has enabled us to become what Peter Lynch, the great investor, described as a wonderful investment. Said Peter, invest in a business that any idiot can run, because sooner or later, an idiot's probably going to run it. At Public Storage, we've been very fortunate to play amateur golf and get out of some tough spots. This has helped us post a pretty good score, and we've learned some lessons along the way that should help our game going forward. Let me share some of these lessons with you by paraphrasing Warren Buffett and our co-founder, Wayne Hughes. Lesson 1, real estate is a very capital-intensive business, and its value is highly dependent on the attitude or mood of Wall Street. We learned our lesson the hard way with storage equities in the 80s. We have since sought to immunize our company from the vicissitudes of the capital markets. In the fourth quarter of 2008, when the capital market shut down, the tide went out and some REITs did not have a swimsuit. Our fortress balance sheet enabled us to repurchase our own securities at large discounts. When the mood changes on Wall Street, it's usually fast and dramatic, so you have to be prepared. Lesson 2, Wall Street is there to serve you, not to guide you, so think differently. Recall the still famous axiom that REITs aren't vulnerable to unsolicited takeovers. In 2006, we acquired Shurgard in an unsolicited, hostile takeover. It was an all-stock taxable transaction, something that had never been done before. The $5.5 billion transaction was transformational for us and the self-storage industry. Thinking different, of course, led us to preferred stock. In 1992, we were told no one would buy preferred stock, especially from a self-storage company. Last year, Public Storage issued 15% of all the preferred securities sold in the United States. We have become the gold standard. Lesson 3, business is simple. There's the cash-in drawer and the cash-out drawer. Open the cash-in drawer and close the cash-out drawer. Business is about free cash flow, not FFO, not net income, not EBITDA. What matters is how much cash, after G&A, after CapEx, after tenant improvements, and broker commissions, you have to reinvest or distribute to owners. You can't produce 18% compounded annual returns for 16 years unless you generate lots of free cash flow. Lesson 4, hire people smarter than you. It's impossible to build an A company with C talent. You can't be the industry leader for 40 years, have the best brand, integrate large mergers, or generate strong organic growth without great people. Each year we have to attract over 1 million new customers, collect nearly $2 billion of rent, and hire, train, and develop 1,500 new employees. We can't do it without great people, great systems, and a relentless focus on cost and execution. There are many other lessons, but I will close with a comment about the REIT industry. 20 years ago, at the beginning of the modern REIT era, Sam Zell said something to the effect, "Let's not screw it up this time." The Great Recession demonstrated, for the most part, that U.S. REITs have developed business models that work and are beneficial to the economy and the financial system. U.S. banks seem to be performing far better with their commercial real estate portfolios, including loans to REITs, than their European counterparts. It appears U.S. banks, insurance companies, and REITs are providing significant liquidity for European commercial real estate. This probably portends the continued globalization of U.S. REITs due to larger and deeper capital markets here in the U.S., as well as a more dynamic and flexible REIT structure. At Public Storage, we will continue to focus on our financial strength, people, customers, and brand, and remain prepared for the occasional out-of-bounds shot. Thank you.
First of all, congratulations to Ron. That was a terrific presentation and commentary, and particularly for the students out there. The lessons that Ron conveyed are something to keep in mind. Our first panel this morning is star-studded. We're delighted to have 3 of the most successful REIT CEOs and arguably the most well-known color commentary person in the REIT space, and also quite a champion of our industry. Mike Kirby, chairman of Green Street Real Estate Advisors. Debbie Cafaro, chairman, CEO of Ventas. Bobby Taubman, chairman, president, and CEO of Taubman Centers. And Don Wood, president and CEO of Federal Realty. We're going to jump right into the questions and try and have an interactive conversation. I think we'll try and leave some time for questions at the end. I'm going to start off with Mike. Mike, as I mentioned, you're seated with three exceptionally talented, highly regarded CEOs who have led our industry with both performance and returns. To note, over the last 10 years, under the leadership of these CEOs, these three companies are in the top 5 in terms of net asset value per share growth, top 10 in terms of total shareholder return, and perhaps a first, Green Street has a buy on all three of these companies.
Kiss of death.
So, Mike, what's their key to success? Why have these executives been and their companies been so successful?
Wow, what a layup question.
Oh man, here's the softball, Mike.
You know, everything Ron just said. I mean, Ron's in that same category in terms of having that same type of track record, and I think each of these executives, I doubt if any of them disagreed with a word that came out of Ron's mouth, because they certainly live their lives as if they buy into what he said, lock, stock, and barrel. I mean, it's kind of a given. Operational excellence is pretty common in the REIT arena, and I mean, Debbie's not necessarily an operator per se, but over here you have two very strong operators. Ron certainly fits into that category. That's pretty common. Most REITs are really good at what they do for a day job. I think what separates these three companies and some of the other ones that have been successful, first, it's that balance sheet. It's exactly what Ron talked about. Each of these companies managed to just fly right through the downturn. Half the REITs had to issue equity in 2009, and boy did that hurt. We heard the opening stats today that per our numbers, property values are down 7% on average, but the RMS is only back to within 30% of its all-time high. That's because the REIT industry had a big faux pas, and it made balance sheet mistakes, and it had to go recapitalize itself. Not these three. So, and I'm sure they'll each tell you what they do on balance sheet to avoid that, but they run smart balance sheets. And they also kept it simple. Their game plans are sort of what they've always been, nothing too complicated, nothing too sexy.
I beg to differ.
I'm not saying the CEOs know. It's very straightforward. And, you know, Don, I think, epitomizes that probably more than anybody, where Federal just talk about a straight focus. It's just right down the middle of the fairway that never seems to change. That's great. And, you know, Sam Zell, I heard his speech from 20 years ago referred to earlier. What he spelled out 20 years ago in what was effectively a commencement address for the REIT industry, what he said is, keep it simple, don't develop. Now, Bobby and I will chat about that, I'm sure. Have low leverage and have no conflicts. Well, that pretty much describes these three companies. And I will say, you know, final point on that, development generally has not been successful for REITs. If it's in your DNA, and with Bobby it literally is in his DNA, it has worked. And so there are companies where if it's what you do well, if it's what identifies your company, if it's really part of your brand name, it's probably going to work. But an awful lot of REITs got into development just as a way to grow when it wasn't really what they were good at. So each of these companies just kept it simple and kept their balance sheets safe. It's not too tough.
Well, thanks for also keeping with Ron's theme of golf. We'll see if we can have each of the panelists have a golf reference in keeping with the day. Debbie, your strategy, and we're going to talk about everybody's strategy because there are some similarities or some consistencies and also some key differences. Yet the result has been remarkably the same, success. But your strategy at Ventas has been driven by acquisitions. You've been very successful in reading the tea leaves, making a bet on industry dynamics, and through terrific execution and integration, delivered results. Why has this approach worked versus, say, a development strategy for Ventas? And then also, is your approach going to be consistent or perhaps change over the next couple of years?
Okay, well, thanks for the question. I think that the key part of what you asked is really embedded in the words. We've had similar results, but we've done things very differently. And I think you have to play the hand that you're dealt in some respects. And so what we do as management, and I've heard a couple people say this over the last 24 hours, that it's not that hard. It actually is really hard, I would say. What management gets paid to do is really to look at the external environment, the macro, and then to look at his or her company, the internal, micro, company-specific environment, and then maximize those two things to create value for shareholders. Okay, essentially that is our job description. And so at Ventas, we have indeed completed 8 acquisitions in the last 8 years. In 2000, we had an equity cap of $100 million, and now our equity cap is $16 or $17 billion. And we've done that principally through acquisitions, as Guy mentioned. And so when we started this journey in 2000 and built our team, I mean, we had to look at the external environment. And what we saw at that time was a very fragmented, very large, $1 trillion healthcare and senior housing real estate market that was very fragmented and was growing. And that's a very good external environment. When you couple that with, for example, in contrast to malls, the public companies only own, say, 2 to 5% of that market. So it was under-owned by the public companies. The demand was there from demographics. The demand, obviously, is a very important part of the analysis. And the last piece of the external that was very interesting is that investors, analysts, didn't really appreciate the asset class. It wasn't in the indices. It really didn't get the respect that I thought it deserved from the fundamental underpinnings of very positive supply-demand fundamentals. And so all of that coupled together, for me to think the external environment is a good acquisition environment. We can really do some good things here given that external environment if we can persuade, for example, the indices to include healthcare real estate, if we can explain the risk-reward benefits of healthcare and senior housing real estate, and if those values could rise and cap rates compress onto ordinary real estate. And that's actually been one of the big stories of our success, is that the external environment has been very positive, and the institutional acceptance has really made cap rates compress. I think there's further to go, but basically healthcare and senior housing have become part of the major food groups in commercial real estate. So that external environment was very, very ripe, I think, for an acquisition strategy. And of course, if cap rates are compressing, you want to acquire as quickly as possible so you can gain the benefit of those compressing cap rates. The second issue was internal, and this was really very straightforward. This was not, we were not curing cancer here. It was simple. We had one tenant, we were in one asset class, it was all government reimbursed. So the strategy, of course, was get more tenants. We also had one capital source of banks. Get more tenants, more capital sources, and diversify into private pay, real estate, senior housing, which is really like senior apartments. And so that strategy in the micro, again, was very promising in terms of developing an acquisition strategy versus, you know, internal redevelopment or some other strategies, external development that people pursue. So we had a unique set of facts where we could actually grow and do acquisitions, which is generally considered riskier, but actually it reduced risk in the company. By growing, we diversified, we got bigger, we lowered our cost of capital, we got in the virtuous circle. So at the end of the day, we were able to achieve through an acquisition strategy the two goals that we have, which is to consistently increase cash flows year over year, as Ron talked about, and to consistently wring risk out of the enterprise. And if you do those two things, I think over the long term, you are going to make money for shareholders. So that's why we pursued an acquisition strategy.
And over the last 10 years, a 20% total return per annum for the shareholders. Similarly, Bobby, you've had the same sort of return, but done it quite differently. When Taubman went public in 1992, you had 19 malls. Today you have 24. You've had one of the best total returns, one of the best NAV per share growth rates over that time. Somewhat counterintuitive. In a market and peer group that suggests that bigger is better, you've bucked the trend. Why and how?
Thanks, Guy. And you know, I do compliment Ron as well on, as Mike did earlier, on the sort of the principles that he laid out of our business. Balance sheets are critically important. But, you know, to your question, Guy, over this 19-year, almost 20-year period that we've been public, we haven't quite hit Ron. He's at 18%. Well, that was 16 years. We're a little over 17% total shareholder return. And we have done it differently. The 19 going to 24 assets, we made the decision fairly early on that consolidation would be part, you know, that we would acquire assets and be part of consolidation, but it wouldn't be our principal growth vehicle. I mean, first, of course, is organic growth. It is executing better than the next guy. And we've always focused on high-quality assets and continue to focus on high-quality assets. And I think the market generally is moving in that direction. When we went public, there were, I think, about 2,100 centers as defined by the ICSC, which is our industry organization, International Council of Shopping Centers. Today, there's something over 1,000. So there's been a tremendous atrophy in the number of malls out there. But high-quality malls have become more and more valuable along the way because all the retailers want to be there. They make a lot more money in those locations. And as they make more money and you can charge more rent, then obviously the capital sources want to be there. So it becomes a virtuous cycle. So number one in our strategy has always been high-quality assets. But we knew consolidation was going to occur, and we wanted to find a niche for us that we felt very comfortable with. We had been a development company our whole life, and we felt we could continue to be a development company. Now, we haven't solely been a development company. As Guy says, 19 to 24 assets, but along the way, while we developed 13 in this period, we also bought 10. But we also were willing to recycle assets and sell them, which is something that most of our peer have not been willing to do, at least on any consistent basis. So we actually would have grossed up to 42 assets, but now we're netting to 24 as we've sold 18. So along the way, our balance sheet has improved as we focused, again, continuously improving the mix of our assets. And development really has been the area that has created the greatest NAV growth over time. And, you know, Green Street and Morgan Stanley did a report recently over the last 10 years who created the greatest NAV growth, and we're delighted to have been, if not, you know, very close to the top, perhaps number one or number two, depending on how you define our peer group. But amongst all REITs that Green Street has followed over this 10-year period of time. But if you look at the last decade, just to put this in context, in the U.S., there were something like 40 new malls built. Of those 40 new malls, we built 9. Maybe half of the 40 we would have wanted to build. So we built a high market share of the ones that we wanted to build, 9 of maybe 20. So those 9, including all the pre-development costs that we wrote off along the way, including one very large write-off that we had, a $120 million write-off on one asset that we were working on. When you add it all up, it was about $2 billion. Well, we've actually created more than a 10% unlevered return against that $2 billion. So today's cap rates, or what we're trading at, there's at least $4 billion worth of enterprise value that's been created with that $2 billion worth of cost. So $2 billion worth of true shareholder value creation. So development has been very important to us, and it'll continue. We've talked about 2 assets that we're going to be starting construction on, 2 U.S. mall developments, one in Sarasota, one in Puerto Rico. We have an outlet center that we start construction on in St. Louis. We have a number of projects that we're working on in Asia. And again, development is in our DNA. We've been able to execute it with really, very clear lines. One of the precepts of our development program is that we want to build assets that would be in the top half of our portfolio. Where our portfolio average last year was $640 a square foot, we've now had 8 quarters in a row of double-digit sales increases. We've never had more than 1 quarter. We've been in business 62 years. We've never had more than 1 quarter of double-digit sales increases across our portfolio up until the last 8 quarters. So sales have been fantastic. So to try to build a new development that would be in the top half of our portfolio is a very hard benchmark. But we believe, clearly in Sarasota, clearly in San Juan, clearly in several other assets that we're working on, we can achieve that kind of a goal. So I think development is another way. It doesn't have to be acquisitions. We do pursue acquisitions. As I said, we've made 10 of them. Recently, we bought a portfolio of 2 assets that were both great assets, $700 square foot assets. There aren't that many of them in the United States. In fact, when you talk about consolidation in our industry, the 1,000 that are roughly left of the assets, most of the higher quality assets are already within REIT portfolios. And if you look at the top 100 assets, probably 80 to 85 of them are in REITs already. And overall, depending on how you count it, at least 700 to 800 of those 1,000 are already in REIT portfolios. And the ones that aren't generally are of a mix that are lesser quality.
So, Bobby, you're on the good side of the total return line when it comes to development, but the vast majority of REITs that were active developers underperform their peer groups. What is it in your mind that segregates that? Why, a seemingly talented group of companies, they all have pretty good credentials at best, but they just, development proved to really come and bite them?
Well, I really do think it's our focus on high-quality assets. We've always wanted to build assets that were well located, that had tremendous anchors, and very large assets, had a big critical mass of space. There were a huge number of lifestyle centers built. In what I'll say, within the last decade. In fact, most of the supply of new space was, in fact, lifestyle centers. Many of those were completely unanchored. And they did not perform well. So there was just there was a huge amount of badly programmed development that was in fact built. There was a tremendous amount of free equity and free capital out there to fuel that supply, and it really wasn't based on a great regional mall shopping center is really not a commodity. You really can't replace it. It really is the whole precept of it is centered on the anchor stores. And if you're going to have a Macy's store, a Dillard store, or Saks and Neiman's and Nordstrom's, they can't go across the street from each other and replicate their business. It's non-economic for them. So it's not just the developer making a decision that also has a capital source. There's a third decision maker in the process, which are those anchor stores that are determining that there is an independent market, free of transfer basically, or net of transfer, that warrants a new investment. So there are other people making that decision as well. When you build a great regional mall, it's not a commodity. You can't knock it off. And that opportunity for specialty retailers to be between those anchor stores in a well-programmed shopping center, a well-managed shopping center, is completely unique. So J. Crew can make money in the mall that I'm describing. They can't go right across the street, in theory, in the same regional market in terms of the demographics, and do the same business. It's not the same economic or profit opportunity to them. So when you create a mall that truly is a non-commodity, that truly is unique in its marketplace, you really have a unique asset that really should be valued very highly. And over time, when you look at these assets, they really grow. At minimum, they grow against the sales increases. If it's just inflationary sales increase, they continue to grow their NOIs. So that's
Bobby,
what our business.
I think what is it that you're better at entitlements, or you're better at getting the right retail? I mean, what is not the secret sauce, but why is it, other than just focusing on high quality assets, is it the right dirt that you bought, or the construction and development team, or the leasing? What is it? You're going to say it's everything.
Well, no, I think it is everything, but I'll use Ron's analogy. We've hit a few out of bounds. Okay, I mean, we did have a $120 million write-off. I mean, we've spent, in that same decade, we spent about $200 million in pre-development that didn't go anywhere. So, I mean, we're spending $20 million a year in pre-development between here and Asia and our outlet assets, and that's what we're writing off. It's just part of our G&A in theory that we're writing off. We stopped doing that, we would have less future growth, but you have to take risks. But you have to have really well-managed risks, and you have to be very considered in how you approach your projects, and you have to be very persistent. One of our great projects, Tampa International Plaza, took us 21 years to develop. We've got, on average, it takes about 10 years to build one of these things. But when you build one, you make a lot of money. So we've got one that a couple of our competitors would like us not to build nearby here on Long Island, that we will build one day. And it is 22 years that we've now been working on that project. And, maybe a few more years. But eventually, we will build our project.
So I think it's an interesting question, because if you do look at that total return chart of the really active developers, the two other companies that stand out are Avalon Bay, which builds anything but commodity assets, and Boston Properties, which builds anything but commodity assets. So they're very hard to entitle, and they sort of fit the profile of a grade A regional mall.
Well, thank you for supporting us.
Let's talk about Long Island.
I hit one out of bounds, but eventually we're going to hit it down the fairway.
It's a good lesson, though, for our students here, to hear that it takes 21 years in some cases to get to be an overnight success and build one of these malls.
I'm not sure it's a good lesson, but it's a reality. Okay, it's a reality.
I would say, certainly for the students, if you want to go and see differentiated execution and product, go and visit some Taubman centers. Similarly, Don, at Federal, under your leadership, you have also stuck to your knitting. You've had a lot of opportunity to deviate. You haven't. But has this paid off for you in hindsight? Would you do anything differently?
Well, I certainly wouldn't take 21 years to figure out how to put retail on the ground. My gosh, it's horrible. Listen, I love this conversation. The one thing I will say about this that's just really important is development's hard, and things go wrong, and it goes wrong in all parts of it. If you haven't picked the right piece of real estate to start, you're dead. If you have picked the right piece of real estate and things go wrong, you can make it up in time. Rents will go higher. It will be successful. It can grow, even if you screwed it up early on, and I know that because basically I have this job because we screwed one up in 1999, 2000, and 2001. It's one of the most valuable assets we have today. But it took a very long time, and with those original errors, the market was able to bail it out. And that's in San Jose, California. If that were in a secondary or tertiary market, it would have probably sunk the company. So I do think high quality and location really is the secret sauce to whether it's development or operations or any facet of real estate. Let me answer your question. I'm not sure I'm sure what it was, Guy, but let me try on one of them. You know, every company, whether you're private real estate, public real estate, technology, wherever in the world, needs a reason to exist. And I think it's really important that every company, and certainly from a student perspective, where you go to work, you make sure you understand what that company's reason to exist is. What is the product that it is selling, and can it be advantageous with respect to its competitors? Why would investors choose you? And Federal's been around 50 years. It's been around, one of the oldest REITs in the country. And for a long time, this business was very different than it is today, much less competitive, frankly. It was a much smaller segment of the investor population. And we grew very lax in terms of what we're doing. And we got into development, we got into a lot of things in the late 90s, and frankly, we lost our way. So the idea was to say, well, okay, why are we here? What's the reason to exist? And very simply, and this is exactly with where Ron started this day, we believe that what our product is a steady, increasing stream of cash flows that, in a very cyclical business, can't be derailed by any one or two particular risks to real estate. And if you think about, well, okay, that's your business, because what I want to be is the most boring guy in this room.
Well,
I
you
want
are.
to make sure. Best I can.
You were at dinner last night, too.
I want to make sure that from investors' point of view, all they're really talking about is whether they're overweight federal or equal weight federal, and not whether to be in federal or not. And that's the goal. And when you think about it, you say, well, all right, how would you do that? It comes to every single decision that we make. Now, Deb said it right away. You got to play the hand that you're dealt, and no question about it. I was dealt a very, very good portfolio to start with. The point from there, in terms of how to keep cash flow increasing every year, is all about balance. And this is what we were talking about at dinner last night. Development, but to a small portion of what it is that you're doing. Acquisitions to a small portion of what you're doing. Operating expertise, which I don't think, frankly, Mike, everybody does do well. I think there's a lot of nuance in operations that make or break it. The bottom line is, what's not been talked about in this room is, in terms of real estate, the first thing you have to ask in any real estate decision is, what's your time horizon? And early along the way, there's a lot of ways to make money playing the timing of the market. We just don't believe we can do it. We're not good at that. So if you're not good at that and you're going to look at everything with a long-term focus, it helps to guide your decisions. It certainly guides your decisions as to whether tenants make up a disproportionate share of your income. That diversity is really, really important. Leverage, as Mike says, it's critical. You know, we picked a cyclical business to be in. That's what we're in. There's going to be a trough, and there's going to be a peak. And you don't really know when that's going to happen. Low leverage is just an important part of producing a steady stream of increasing cash flows. It's just critical. Lay out the tenant base, lay out, most importantly, the quality of the real estate. And I know you hear that time and time again, but I can absolutely tell you, one of the great things about analyzing real estate in 2012 is that in just the last 5 years, there has never been a time where you can look at a portfolio of real estate, the country, and understand the highest of the highs in 2007, the lowest of the lows in 2009, purgatory in 2010 and 2011. What are we talking about? Here's how the stuff performed. It really happened right in this window. It's not speculative.
Exactly.
And there's no doubt that the close-in areas with assets with reasonable leverage on them in a supply and demand business, man, it's just supply and demand, clearly outperformed those in places that probably shouldn't have been built or are oversupplied in the first place. I very much believe that the country is oversupplied in terms of retail, and I'm speaking retail now. I think there is just plain more supply than there is demand.
I agree.
I don't think that applies across the board in every location, every place, but I do think on a macro basis that's the case. That says you got to be really careful in terms of where you're operating, where you're building, where you're acquiring, more so than ever before, because that distinction between places where there's opportunity and places where there's not opportunity has never been wider. I don't know, I'm going to stop there for a while. What do you think?
That was the exact answer to the question I was looking for. All right, Mike, so back to you. Cost of capital, right now, arguably all-time low. Stock prices, in many cases, at all-time highs. Looking at over the horizon, what is going to go wrong the next 2 years?
Okay, so commercial real estate, what causes commercial real estate to blow up? Some of the past commercial real estate debacles, in fact, most of them have been caused by excess development. It's just not even on the table. There might be a sector or two, apartments, I could make a far-fetched case a few years down the road, assisted living facilities, maybe. But there's just no sign that that's imminent, and construction financing is scarce, so we're good. So that's the biggie. That's been the cause of debacles before. More recently, the last downturn was caused by a demand shock. Now, demand shocks are really hard to predict. They fall back into what Don talked about. There's the knowable and there's the unknowable. Look, I don't know if Spain's going to be borrowing money at 12% next year. If they are, I'm guessing these folks are going to have some really lousy demand for the space they have to lease. That could certainly happen. It's really hard to predict. So let's just put that aside and count it as an unquantifiable risk, but a very material one. And that's, again, it just harkens back to why you need to have a bulletproof balance sheet, because you don't know when the next 100-year flood is going to come. Otherwise, it's new normal isn't good for everybody, but it's pretty good for commercial real estate. It's a world where demand growth is positive. It's pretty unimpressive versus what we're used to in a recovery, but it's positive. And with no new supply, it just means it's a long slog uphill in terms of regaining lost occupancy. The REITs owning higher quality properties tend to be doing a lot better than, say, pedestrian real estate. We certainly see the recovery in REIT-owned real estate. It's been quite strong, actually, at least price-wise, not so strong fundamentals-wise, unless Bobby's portfolio is doing great. But most REIT portfolios are doing okay. So I guess, so the other big risk would be price risk, and what could cause price risk? That's a rapid increase in interest rates. So again, this one falls under the heading of what can you do about it? I mean, are we going to go into a big inflationary environment? Are real rates eventually going to come off the zero level they're at? Maybe someday, probably someday, but what can you do about it? I mean, it's for now. We've had some capital raises that are just stunning. I mean, Ron talked about his sub-6 preferreds. We had David Simon do a 3.4% 10-year unsecured. And you can sell equity. Most of these folks can sell equity, and a lot of the quality REITs can sell equity at a substantial premium to asset value. And so I guess my advice to REIT execs is if you have that luxury, go get it and take advantage of it, and de-lever at the same time.
Debbie,
if I can just add to that, I mean, I think, Mike, what the underlying point that's being made, and it's an important point, particularly for students in the room, is we've answered the question of time horizon on the real estate, and we are long-term holders of that real estate. There's the left side of the balance sheet. You got to make sure the right side of the balance sheet matches that time horizon. So the idea of an interest rate environment today, which is causing prices to be very high, no question. So you're buying things or operating things that are very expensive. Well, now is the time to make sure that the right side of the balance sheet, the cost of that debt, the term of that debt, the laddering of those maturities is set up such that when the inevitable increase in interest rates comes along, you've matched appropriately your assets with your liability.
And what you're describing is what happened with General Growth.
Yeah, that's right.
I mean, they really played against all odds, and when the stuff hit the fan, it all hit the fan. And when it's moving against you, it's moving against you, so you don't have a choice. They actually did have a few choices, but they ignored them, coming up to the sort of the cliff. and they got mismatched, and
Yes.
they blew up.
I mean, there are REITs, I'm not going to name names, but there are a good dozen REITs that are still operating at higher leverage ratios than they were back in '06 and '07. I find that unbelievable. I mean, come on. Didn't you learn something? So, that
Well,
is...
Mike, sometimes though, and I think this is really ironic, I think sometimes if you think that you made the right decisions and you survived the 100-year flood by doing what you did, which is to take a risk and win, then I think it has an oddly reinforcing aspect to what you did. And you say, well, gosh, if I could survive that, then I did the right things and I should do it again.
Yeah,
so I do think there's
the ones I'm referring to
perverse-
generally are the ones that did go dilute themselves, and I'm not sure they really understand how much they diluted themselves.
Okay.
They
They're obviously not
survived.
reading your stuff.
They're alive, but they're happy that they're alive, and they know a whole bunch of people who aren't alive, and they think that's good. I don't.
Debbie, you don't like to sit on your hands. So what are you going to do over the next couple of years? And do you agree with Mike's perspective?
Well, I do think that there are significant macro risks that most of which Mike described, whether it's interest rates. On the other hand, I think we have a possibility where we'll actually have another, not a demand shock, but a significant zero or even negative in the GDP if we get to the end of the year and we see some combination of spending cuts, higher taxes, et cetera, sequestration on the budget and things like that. It's very hard to grow in a deleveraging environment, and fiscally we either are or need to be in some kind of deleveraging posture, and that'll be again a combination of budget cuts with some tax increases or revenue enhancements, as they like to call it. And so I think growth is still going to be pretty hard to come by. That could make the opposite case potentially for interest rates. So while I think the majority case is at some point interest rates are going to rise, and I agree 100%, we should borrow long. You should always borrow long when you have long-term assets, as we all do, and never get caught in the way Bobby described that GGP did by borrowing short and betting the ranch for another penny of earnings. The risk-reward just isn't there. So in that environment, I think we just continue to do what we've done. I see continued consolidation in the REIT sector. We see consolidation among our tenant operators in the healthcare and senior housing business. I think that's a very dynamic environment and one in which we would hope to be opportunistic for the benefit of our shareholders, find a way to allocate capital in a changing, consolidating environment on the operator side. And then I think on the healthcare side, you're seeing a lot of what I call convergence, but where different sectors of the healthcare operating business are gonna, I think, become more vertically integrated as healthcare rules change. And so our job is really just to drive down our cost of capital, make sure our existing portfolio is performing, and then stay strong and financially flexible so that we can allocate capital opportunistically in this ever-changing environment. And one question I would actually pose to Mike and the other panelists is, in Europe, the REITs tend to be multi-sector REITs. They are in a single country in many cases, but they go across sectors. And one kind of secular question that I have is whether REITs in the U.S., as consolidation continues, really should become multi-sector, or whether that would really destroy value and focus. Because most of the sectors do touch at the margin. And you saw Simon going into the outlet mall business. That's a very small example. We have 55% of our businesses in senior housing, which are really apartments with amenities for seniors. That sort of touches the multifamily business. Do you ever see convergence across sectors? Is that or would that be a value-destroying kind of consolidation?
I'll give it a shot first. My answer would be, I hope not. I mean, but I'm open-minded at the margin, and Bobby's doing a little bit of the same thing David is with the outlets, and that's sort of nibbling away at the margin. It's just a little bit, it's almost a different variation of the same property type. It's got the same tenants in it, so it's, to me, that's awfully close. So I'm not going to get too excited about that. But the history, European public real estate, unfortunately, has been a big disappointment.
It
And,
has.
you know, we and a lot of other people set up shop over there 5 or 10 years ago. For a lot of other people, 10, and for us, 5. And it's been a big disappointment. And a lot of the reason it's been a big, I mean, they've had very subpar total returns. The market is a lot smaller today than it was 5 years ago. We all had high hopes for what it might become 5 years ago. And I'd say the biggest reason is because the companies there are just not adhering to the rules of the road that were spelled out here earlier. They're not simple. They're very active developers, most of them. Most of them have a lot of leverage. So a lot of leverage plus active development is doubly dangerous.
Yeah.
And they're pretty unfocused. Now, will they learn? Will there be change? Yeah, I think they're going to move to our model. I don't think we're going to move to their model, you know, with some small exceptions. I mean, to me, your business is a little different because you don't operate. I mean, you
Right, other than medical office, right?
Right. And to me, that's a little different. It gives you more of a carte blanche to do it differently than these guys.
You know, our mantra is high quality retail real estate. So, you know, whether it's outlets, I mean, we're using, it's the same tenants, as you point out, same capital sources, the same executives on both ends of the spectrum. So, you know, to us, you know, at the margin, there's a lot of synergy. But for us to get in the apartment business, we don't know anything about the apartment business, and we don't know anything about the office business. And we've had a few personally. And, you know, generally, they've been bogeys, to use the analogy. But I do think you can morph into areas slowly, you know, a step at a time. And, you know, you mentioned Europe. I think, Guy, you said that out of the top 50 real estate companies in the world today, what was it, 10 years ago there were 12. Today there's just 2. So I think that, you know, the world is moving them by quickly. And consolidation, I think Simon's acquisition in Europe recently is a good example of the bigger companies on a global basis are going to be acquiring elsewhere. They need to find growth. And you said it earlier about the retail side, you know, there's supply is constrained, and it's going to be constrained for a while. So, you know, is there the organic growth in the United States, just demographically, to allow significant new supply? In our business, you know, I said there were, in the last decade, there were 40. I've been saying there'll be 15 to 20 new malls built in this decade, and I'm the only guy out there that believes that. Most people think it's going to be 5 or 6 or 7. But, you know, so you do have to find growth, but it's got to be growth that is contiguous and understood by not just the company, but also all the external constituents you deal with, including the investment community.
Let me try just a little bit of a contrarian view on that, and something I don't know how Mike's going to feel about this, but I'll try it anyway. We've actually been pretty darn successful in the apartment side, in conjunction with the retail, and it's really interesting. I'm a firm believer that commodity-based retail, because of the internet, because of a lot of other supply factors and things like that, is not particularly a place I'd like to invest in the next 10 years. You know, I don't see a lot of growth there. Yet, experiential real estate, and I don't mean kind of fake lifestyle center stuff that you know, we've seen that party and it you know, it doesn't have a reason to exist, right? But there are many urban areas where apartments over retail, in some cases office over retail, really work together extremely well. It's really interesting in somebody who believes in mixed use in certain places. The retail on the ground floor helps the residential far more than the residential helps the retail. So, you know, we're doing a project in Boston. Avalon Bay is our partner. They'll be building the residential. We'll be doing the retail. Very hard to get that residential builder to step up and pay the real value of that residential because they don't know whether that ground floor is going to work and they don't want to underwrite that it's going to be fantastic. But we've done that in a number of places, and in every place that we've done it, that residential has effectively outperformed the retail. So it's an interesting mix. Well, we'll always be a retail company, but to say that we won't do residential as part and parcel of that retail, I don't think they're as different as maybe you think they are. Now that's very different than saying, okay, I'm going to go out and do an apartment complex over here, unrelated to any of the retail that's there, or an office complex that's unrelated. But those mixed uses in the right demographics can make you a lot of money.
I think it makes a lot of sense you got Avalon involved with you.
Up there, I think that's right. In Maryland, we're doing it all ourselves. In San Jose, we did it all ourselves. Depends on the market, depends on the project.
Bobby, you touched on international. Why are the mall REITs, including yourself in a very unique way, why are the mall REITs going international? Are they risk-adjusted returns better than in the U.S.? How do you think through that, and why is it that the mall REITs are looking abroad?
Well, I mean, it's growth. I mean, it's you know, we talked about supply being constrained on the development side. We've talked about consolidation in our sector really having occurred. I mean, I said on one of my conference calls when we bought these two assets over $700 a foot that our view of the world was there are only about 60 assets in America that do $700 a foot, and all but 15 of them are owned by REITs. Now, you know, your firm actually did a study that said there are only 50 of them. So, but somewhere between 50 and 60, you know, at some point you have to find your organic growth. I mean, we're going to have wonderful organic growth over the next several years because we're getting the halo, basically the benefit of the of this high sales growth environment that we've been in. So, you know, we'll have great organic growth, but as you look out over the next several years, we need to have external growth. So we are finding some in the U.S. I mentioned Sarasota, San Juan. I mentioned Chesterfield. We'll hopefully be able to build some more over the next 10 years, U.S. malls. But we went to Asia 6-7 years ago because we perceived the flow of opportunities were going to be less here for development and, for that matter, for acquisition, so that we wanted to open up a new market to us. But, you know, clearly, you know, Simon's done that, and they continue to do it with Chelsea on the development side. They do acquisitions across the board. You know, others have done it in our sector, and I think will continue to do it. So I think other REITs, you know, while you have much greater market size for all the other property types, so that in theory you don't have to go international for if you're even in the strip center business, the apartments, the office, whatever. I still think you're going to see those solid businesses with good balance sheets looking elsewhere to open up other markets to be able to allocate capital where it seems like it's the best place to go.
Don, what are your thoughts? Lots of fascination.
Well, first of all, it scares the hell out of me, so I'm not going there for federal. But the point is, especially in the larger, well-capitalized companies like Simon absolutely can take that chance. They've got the balance sheet, they've got the size, they've got the ability to be able to try things in a reasonably balanced way that most of us don't. I think the hardest thing about investing, because this is all about capital allocation, is what should the required return be? How much of a premium, because there certainly should be some premium, investing in a different place than you're from than you would assume in your own backyard. So what should that required premium be? I think that's a really hard thing to figure out.
Yeah, if you're going to Asia, as we are, you're in China, there are all kinds of people who want to build there. The capital's the same. It's with global capital sources. Right. So capital is competing. That's feeding those developers and feeding, you know, acquisition, you know, buyers. The capital is looking at that market and pricing that capital no different than prices the capital here. Is they're viewing the growth there versus the, the initial yields as making up for that risk. But, you see a very competitive, more competitive in many ways in Asia, in China specifically.
On the capital side.
On the capital side, on pricing.
You're saying first year cost of that capital.
First year
But
cost
not
of
the long-term cost of that capital is higher, right? Because they expect more growth.
I would argue it's very close to, if you're going to do an IRR, 10-year IRR, 15% unlevered here, it's sort of a benchmark. Hopefully we'll do better, and we have done a lot better. But over there, it may be the same. Okay, but and to get to the 15% unlevered, you're actually saying you're going to have to see 10% kind of growth in your NOIs, in sales and NOIs over an extended period of time. And, and if you can't get there, I mean, the global capital market is saying that's what it's going to, that's the price of capital.
Right.
Okay? That's the price of doing business in China.
But China's got to be riskier than here, right? I mean, the
Well,
IRR
but
has
it
to
is
be
to
high.
you. It is to you, but it isn't to the people that are doing business. Do you think it's riskier to capital land than being in Singapore? Do you think it's risky? I mean, all the people that are there doing business that you're competing with now, if they have to come here, do they view that they need a higher risk reward? Do they have a higher risk reward here, higher risk-based capital for them?
We have a pretty tested capitalistic system. I mean, theirs is still, I wish them well, but
Yeah.
But our system's growing at 3.5% if you
Well, I
get
get the
lucky.
growth is higher there.
Well, okay, but
But the
that's all
IRR
part
would
I-
include the growth.
Yeah, I mean, I think Bobby's, you're both right that we can't get a higher return when we look abroad because there are other capital sources that are willing to take lower returns.
Yes.
And if we wanted to grow there, we would have to meet that. At the same time, it could be riskier for us because we are less familiar. Well, first of all, we're less familiar with the local markets, and secondly, China and others don't have established principles and rules of law and interpretation about how capital is treated and ownership is treated and things like that. So it really is a conundrum. I mean, I do view international expansion as a natural extension of growth and diversification. I do. But whenever we've looked at it, we haven't been able to make it work because the cap rates are low and the risk, both the perceived risk and probably the real risk in some of the jurisdictions is higher. And there's also costs, tax and other things. But so I think it's very hard to make it work out. And I think the mall sector is probably the right sector for people to start going abroad for all the reasons that Bobby talked about. And when we look at it here in the U.S., if we still have so many opportunities that are untapped because of the size of the market and the penetration of the public companies that we tend to be pushed back into the U.S. But I can certainly see what Bobby's saying. If you want to play there, you have to pay the cap rates that global capital is prepared to pay.
Particularly in the mall sector. I think it makes a lot of
Yeah.
sense.
Yeah, I mean, the mall sector is the obvious sector.
It
you
is.
know. And the skill sets, the relationships, the global tenant
tenants,
relationships.
exactly.
Are very critical. The
Right.
programming, I mean, people buy stuff there just like they buy stuff here, and retail programming is very consistent. And those skill sets need to be applied there. And so, but nonetheless, you come back to capital, and you say,
Yes.
how much more risk do you apply to that situation? How much do you perceive? How much would they perceive coming here? What's the growth rate? And is it all captured in that IRR? You know, is a 15% IRR, is that can you achieve that here? Can you achieve that there?
Right.
Where can you allocate capital?
Yes.
Can you do it here? Can you do it there?
Right.
And last point, I'll say, Europe is on sale, and their banking problems are a lot worse than ours. Their real estate business is a lot more messed up. I think there's going to be some wonderful opportunities. I think Simon may have just found one. But I would hope, for the most part, the U.S. REITs stay out and leave that to Blackstone to go fix, because I just don't think it's the core competency for most REITs.
Let's switch gears. What's wrong, I'm going to direct this to everybody, but particularly you, Mike, what's wrong with the IPO picture? Why haven't more companies, higher quality companies, come to market? Surely it has nothing to do with REIT compensation or executive compensation levels, because that's pretty attractive. So what is it that, why haven't we seen more high-quality companies coming?
There aren't a lot of, there's not an abundance of high-quality private real estate companies out there. There's a few that we know to be in the queue, I think all of which were taken private at one point. And I look very forward to seeing how those trade. But so far, we've seen a potpourri of either blind pools, which seemed like a good idea for about a month, and then it didn't. We found out there was no distress, and so that fad came and went. And then we've seen some pretty legitimate, nothing where you look at these companies and say, boy, I don't like that. But there's also nothing particularly great about them either. And the problem this class has is they're being compared to companies that have some pretty impressive public track records. And yes, there are, trading above NAV is sort of a prerequisite for a REIT to come public. Why would you come public if you can't hope to achieve a price worth more than your real estate? It's not easy. It's even today when most REITs trade above NAV, it's generally just the good ones. And that's a tough peer group. That's tough to get that kind of pricing. So I think it's the mix, and plus even the small, pretty decent companies that have come public, a lot of them are $2 billion in assets, $1 billion in assets. It's hard to be public with that kind of, it's hard to cover the G&A load. It's hard to run your business while trying to be public at that size. This crop was able to do it because there was nothing better, and the costs of being public weren't so high. But I'm hopeful. We're going to see quite a few more stabs by brand names that we all know, and they've been tested in the public market. And I think it'll change. I think the market will be much more receptive to the brand names that we're comfortable with. Archstone was once a public peer of Avalon Bay, and they were both treated, along with Equity Res, maybe at the top of the apartment heap. There's no reason why that wouldn't happen again, if they do try to come public.
But for the smaller companies, once you take a discount and banker fees, which I know are near and dear to your heart, there is a better execution for the owners of those businesses, which is to sell to one of the public REITs. And so the math just doesn't work. And that's been a big component of our acquisition pipeline over the past couple of years, is the owners saying, I can go public, or I can have a certain execution into a liquid security with a dividend that's very certain, and the net amount of that is more than I would get net if I went public. So I think that's a pretty straightforward analysis. And honestly, so many of the acquisitions that we've either looked at or actually made over the past years, we're comparing less to what a competitor could pay, although we still do that, and more to building the target's IPO model and figuring out what that is, and then pricing sort of off of there so that the owner gets a better outcome, a more certain outcome, and absolute dollars better, and we're still getting a deal that works for our constituents. So I think that's part of what's been quote unquote wrong with the IPO market, is there's a better outcome than an IPO for the owners.
I do think the mall sector is sort of the precursor for what's happened generally over 20 years in the public markets with real estate. When we went public, it was a $10 billion market flow. Today, it's over $500 billion. We heard that earlier today. And it's not always easy being public, but on the other hand, it has worked. Okay, yes. And it's worked for all of us sitting here, on this panel. Davis Street, which was these two assets that we bought recently, is a case in point. They're a private company. They'd built several good assets. These two assets were exceptional. They had a third asset that they had redeveloped from St. Louis that they'd done a good job with, that they sold again to a REIT. They can't, many years ago, with three assets and sort of a conversation, Verizon Pension Fund was their big capital source. They might have been able to create a public story to be able to go forward. But it's just not possible. It's too small an entity. It didn't have a real growth story. The only story it really had was its organic growth. And we became a logical place for them to capture the value they had created. We cashed out to Verizon, which is a not-for-profit pension fund, and then they took our shares, they took our units, and it was a terrific tax-efficient outcome for them. And now they have the opportunity to participate in our growth and not have to recognize the taxable gain that they had created. So I think the public vehicle has become a wonderful exit for private market assets. And, in another era, that small company might have created itself as a new public IPO.
Yeah, I guess the only thing I'd add to that is it gets right back to the first thing I think I said today, and there needs to be a reason to exist. Right. And when you sit and you say, well, okay, I've accumulated $1.5 billion or $2 billion of average, in most cases, real estate in whatever sector it's going to be, and you're competing with investor choices that are much better established, probably have better growth prospects, certainly have lower risk in terms of what's going to happen. Why do you need to exist? So I know the bankers need the fees, and there's no question more should happen from that perspective. But other than that, there needs to be a compelling, story that you can tell to be able to provide a better alternative than what's already out there.
So maybe
That's a high bar.
Maybe this is the way the IPO market is supposed to work,
Yeah.
which is that it's screening out companies that, to use Don's words, don't have a reason to exist, and we've said we think there should be fewer REITs in general rather than more. So it should maybe only be the exceptional companies with a growth story, with scale, that should be taken public.
Notwithstanding the fee-seeking missiles.
Notwithstanding.
Well, thank you for each of you for joining us. It's been a treat for me. 3 of the best CEOs, 4 of the best minds in our space. And with that, I just ask everybody to join me in thanking the panelists.
Thank you.